What's up, everyone? It's Scotty with MoneyVest. So Tom Lee coming out with a massive headline suggesting for a, quote, violent rally before the year's end. I'm also going to break down a couple comments from both Bowen and Mary Daly on interest rates. And we'll take a look at the markets, of course, from a technical standpoint and what levels to really be paying attention to moving forward. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. That's all I'm asking in return, is that you drop a like and subscribe to the channel. And link to our Discord and Patreon is going to be down below if you're interested in joining. And of course, getting access to all the buy and sell alerts, options alerts, trade ideas, members only videos, our intrinsic value spreadsheets, our individual stock reports. Everything is going to be included with the link down below, and the fundamental and technical analysis courses as well as the options course is going to be available in the description as well. So we'll love to have you on board, and if you have any questions, feel free to reach out. So this right here was the headline: expect a violent rally before the end of the year. And this was on Twitter, and then somebody posted a comment, kind of replying to this headline, basically saying the rally on December 28, 2023, 0.01%, and everybody just going crazy over that very, very small, minuscule return. But of course, the market's kind of full of memes, and that's what makes it really exciting and fun, right? So investors should remain optimistic that markets can rally before the end of the year. And he says, and I quote, "I think investors should remember that the best opportunities to really make money are during periods of fear." Something that we have talked about on the channel, whether that's March of 23 or October of 22, it still makes sense to be constructive, but it does feel terrible out there. And if you come over to the markets and S&P 500 more specifically, we talked about this exact same thing, right? I can literally just count in my hands how many times there's been some serious buying opportunities. And what you'll notice is that there's been only a few. So one of them that he's talking about was obviously back in October of 2022 here. Another one was in March of 2023. There was another one in, December 22, just, dropping a little bit aggressively. So a double bottom here. And this right here is the fourth time, September, October, and this is the entire sell-off that we have witnessed for the market, where, we've pretty much dropped a little bit over 8.45% from those highs. So there's not really been a lot of opportunities for us to dollar cost average into, but this right here at 4,200, in line with that 200 simple moving average. So that 200 SMA sitting right there in blue at 4208 has been a very nice technical support for the market. He says the average S&P nominal return is 8%, and after a drawdown like this, it's probably 10% a year. And given that the 10-year yield is around 4.8%, so someone could invest their money today in the S&P and earn double the return over the next decade, or they can earn half of that owning a treasury bond. Now, it's kind of interesting, that Tom Lee kind of puts this in that context that, okay, yes, 4.8% is where we are right now for the treasury bond, and you could earn twice as much, by investing in the S&P 500. But, what's interesting is that, look, investing is all about understanding both risk and reward. What he's highlighting in that statement is that, yes, you could indeed theoretically earn double the return, because now the nominal rate of return, for example, S&P 500 is close to 10%, and the yield on the 10-year is at 4.8%. But what does it not account for? The risk, right? That's the biggest equation. That's the biggest piece of the entire equation, is the risk, right? 4.8% is risk-free, right? The only risk there is the fiscal risk, the fiscal deficit risk. But with S&P 500, there's so much risk related to equities, right? And superior investing is all on the basis of risk-adjusted return. It's never an absolute return. That's exactly what's been discussed by Howard Marks in the book, Most Important Thing. And he says that only sophisticated investors can ever understand what it's like to have an outperformance on a risk-adjusted basis. That's what superior investing is all about. It's not always about making more than the market on the way up, but it's also about losing less than the market on the way down. And that's all around risk control. It's all around risk management. And, one of the things that we talked about is that, yes, 4.8% is true for the 10-year treasuries. 1 year is sitting at over 5. 6 month is sitting at over 5.5, right? 2 years sitting at over 5. So a lot of the shorter end of the curve is sitting at over 5%. And the interesting thing is that, of course, they carry almost little to no risk, because the short end of the curve, is even less risky than long end of the curve, because 10, 20, 30 years, we have no idea what's going to happen with the fiscal deficit over the next 10, 20, 30 years. But in 6 months, 1 year, 2 years, there's a lot more predictability as opposed to 10, 20, and 30 years. And what's also I want to mention is that as yields continue to go higher and higher, what that's going to do is it's going to push the risk curve farther out, right? So while the aggregate market, S&P 500, may have a nominal return of 10%, and that's very average and that's very expectable. But when it comes to individual stocks, now we're going to start to use like a higher rate of return, higher required rate of return, right? Because see, logically, the way it works is that if the yields on the treasuries gets up to 5% or 6% or 8%, for example, now 8% return on equities is worthless. It's literally garbage because you can make 8% on treasuries. So now you need to account for 12, 14, 16, 18, because you are taking on that additional risk. You want to be compensated for that risk. That's what risk premium is all about. And that's why we got to push our risk curve, and that's going to increase the appetite for risk, and thereby investors are going to want to reach for higher return, but that higher return is not going to come free. It's going to come with a higher level of risk. And that's what's going to be really, really interesting if the yields continue to move higher, right? And he also says that he remains optimistic that Wall Street could see a, quote, pretty violent upside rally. And he sticks to the previous forecast of 4,825 points on the S&P 500 by the end of the year. And that's going to put us, somewhere around here, 4,825. That's going to be about almost a 12% rally, and almost back up to all-time highs for the S&P 500. That's exactly what he's seeing from the markets over the course of next quarter, over the next 3 months here. And we know that October, November, December is usually the best time of the year. He says, I'm pretty confident that we're going to have a nice rally into year end, and much higher from where we are now. But it may not start, I don't know when it starts, maybe next week, it maybe starts tomorrow, it starts maybe in 3 weeks. He doesn't know the timing, but he is very confident that we are going to have a very nice rally into the year end, and we are going to be much higher, he says, from where we are now. So, take it with a grain of salt, take it with however you will. We know that Tom Lee is almost always bullish, but, I don't doubt, considering the statistics and the seasonality trends, October, November, December, especially December, is the best month for the market. So, I actually wouldn't be surprised if we do see a bit of a rally here, considering that interest rates are also coming to an end when it comes to the rate hiking cycle. Inflation's cooling off. We're going to get that report next week, and the markets were also technically very oversold, and as a result, we did see a nice rally back up on Friday, and I wouldn't be surprised if you do see that momentum kind of carry forward in the next couple of weeks as well. Now, Fed's Bowen says that it will likely be appropriate to raise rates again, and she says, and I quote, I expect it will be likely to be appropriate for the Federal Reserve to raise rates further and hold them at a restrictive level for some time to return inflation to our 2% goal in a timely way, and I remain willing to support raising the federal funds rate at the future meeting if the incoming data indicates the progress on inflation has stalled or is too slow to bring inflation to 2% in a timely fashion. On the contrary, Mary Daly says Fed can hold rates steady if the job market inflation cool further. So again, we're getting a little bit of mixed views, but that's what makes up the Federal Reserve's, committee, the FOMC. Some members expect higher rates, some members don't. Some members expect a pause. So the next meeting is going to be on October 31st, November 1st, and that's when we're going to get that final decision from the Federal Reserve. And of course, we got another meeting coming up in December. Now, this right here are all the targets from all banks, all Wall Street banks here and firms on S&P 500, and these are all as of September 20th, so literally less than a month old. And the highest target comes from Oppenheimer at 4,900 on the S&P. That's kind of in line with Fundstrat Global, right? So Tom Lee's up there. 4,825 is their number. We got Piper Sandler. We got 4,825 alongside, Tom Lee. Societe General, we got 4,750. That's been updated, right? So take a look at these upgrades from literally June 13. And that's what happens with sentiment, right? These are not macro-driven price targets. These are sentiment and momentum-driven price targets. 3,650, 4,750 is where they are. Credit Suisse is going to be at 4,700. Bank of America, 4,600. Citigroup, 4,600. BMO Capital Markets, 4,550. Goldman Sachs, 4,500. Deutsche Bank, 4,500. Evercore, 4,450. RBC 4250, JP Morgan 4200, 4200 for Jefferies as well. And we got some of the lower targets by BNB Paribas at around 3400. That's going to be pretty brutal, to say the least. We got Morgan Stanley at around 3,900. Of course, we know that Mike Wilson's been very, very bearish on the markets as well. UBS, we got 3,900, and Capital Economics also sub 4,000. Wells Fargo, Barclays in and around that 4,100 level for the S&P. So the median or the average targets at 4,167 on Wall Street, which actually means that, out now from till the year end, or actually this is going to be updated to 4360 now. That was from back in June 13. This right here is from September 20th. So 4360 is where the target is. That means, a little bit of upside of about 1% from where we are. So very, very muted third quarter. But as we know that, Goldman, what do we got? Bank of America, we got Societe Generale, Credit Suisse, Piper Sandler, Tom Lee from Fundstrat, Oppenheimer. They're all expecting at least 6 to 8 to 12% upside for the market over the close of this year. Now, this, unfortunately, I hate to break it to you guys, but this is a losing game because, nobody can actually make predictions in a very consistent fashion. So a lot of people ask me, like, Caddy, what's your prediction for where the markets are going to close by the year end? And to be honest, like, why even play a game where the end outcome is always going to be a lose-lose, right? So I don't play that game. It's not about making predictions. It's always understanding whether it makes sense from a risk-reward standpoint to be a buyer, to be pulling back, to be holding patiently, or to be selling. Where are the markets trading right now? What's the temperature of the overall market? So what I would appreciate a lot more is an analysis on the risk and reward and the current market valuations, as opposed to constantly trying to predict where the markets are going next. I think that's really, really important for all of us to understand. It's not a predictive game. It's a reactionary game in the market. So let me know your thoughts down in the comment section below. As I've already mentioned, I think this is the fourth serious dollar cost average and buying opportunity in the markets. We already got one in October of last year. We got one in December of last year. We got a March this year, and now October of 2023. Once again, the fourth serious and good buying opportunity and dollar cost averaging opportunity for us. But that doesn't mean that the markets can't go lower, right? Just because the risk reward is now attractive doesn't mean that it can't get better, right? So that's something that we have to understand, is that, again, at the end of the day, nobody really knows where the markets are going to bottom out and where the markets are going to be topped out. So hope you guys enjoyed this video. Found it helpful. If you did, make sure that you drop a like. Let me know your thoughts down in the comment section below. Hopefully you got a little bit of value out of it. So subscribe to the channel. Link to our Discord, Patreon is going to be down below. And as always, happy investing, and I'll see you all in the next video.